Hello and welcome. I've kind of caught up on all the latest esports competition cases, and I've had a couple of days of self-indulgently just playing games that I've been haven't had the time for. But now it's time to get into another part of my backlog, which is the FMWC cases. So I haven't done the longest, hardest question from any of the last three rounds, 5, 6, or 7. So I'm going to start with round 7, both because it's the most recent one and also, honestly, because it's the easiest one. And we'll see where we get to from there. So let's start with the PDF for this one. So there's some just general notes here about how this is like greatly simplified versus real life cap tables. So, we're excluding taxes, we're excluding inflation, we're not worrying about fractional shares and various other things. We're going to assume that the forecasts and the actuals just match, keeping it nice and simple. There's also a kind of framework financial model. There's a very, very simplified set of financial statements, and there's a framework provided for that, just so you kind of can't go wrong. So we've got two founders, Abe Abelson and Billy Bates, who found the company at the start of 2025. Then they're ready to sell it on the 1st of January 2030 to the FMWC. But they've lost all their historical financials. So what you get is this PowerPoint with notes on what happened financially and also on their cap table, which is the bigger modeling challenge here. Yeah, the rest of that I don't think we really need. So founder salaries and shares, they put in 100,000 each as startup capital. They each received 100,000 shares based on a 2025 share price of $1 a share. They agreed that they should be paid $250,000 a year, but they'll forego all or part of their salaries in exchange for additional shares, which will be issued at the start of each next year based on the salary foregone and the share price in the last year. For example, in 2025, they're each foregoing $250,000 of salary. So on the 1st of January 2026, they'll each receive an additional 250,000 shares. So the important thing is it's based on the previous year's share price. The company will be valued at either 2 times revenue or 6 times adjusted EBITDA, whichever is higher. In year 1, it's valued at a fixed $200,000. Adjusted EBITDA will adjust EBITDA for the full $250,000 salary for each founder if they forego all or part of their salary. The value of the company and the price per share is determined at the start of each year and will not change during the year. And then there's stuff about an employee stock option plan, which we'll come back to later. So the first couple of parts are fairly standalone, so I'm going to deal with those first. So first, there's a personnel schedule. So starting in June of 2025, they hire their first 3 employees, 1 director and 2 associates, and then they carry on hiring at the start of 26 and so on. So what we need to figure out is 2 things. One, everybody has a salary, and the salary changes when they get promoted. But not with inflation, because again, simplified model. And then the second thing is everybody has shares, so initial shares on hire and additional shares on promotion, which is just, I guess, bringing them up to the level above. So what we want to figure out is for each year, because we need to be able to plug these into the financial model, we need to figure out how much salary gets paid to everybody that year, excluding the founders. We'll handle those separately, and how many options are vested. The options vest over 36 months, 3 years from when they're awarded. Okay, so let's break it down. We've got, I'm just going to go off the year start date. So say year start. I'll just link it up to here to be connected. Okay, now I will say that I've got the kind of official solution model here, for reference, so I can check as I go along, so I don't screw this up. The FMWC style, and it's a very sensible and appropriate style for many situations, but it is, compared to my style, very verbose. So there's a detailed schedule of what level everybody is every month for the entire model period, what salary they have every month, and various other things. It's like what I'm going to do in a few dozen cells is like pages and pages here, which again, that's not wrong. It's actually, in many situations, it's good, but I'm going to do it more like I would do in the competition, which is a little more dense. So first we're going to do salary by year, and then we're going to do options. So we'll start with the salary. So we have this format: hire date, promotion date. So first thing I'm going to do is you got to go month by month because someone can be hired in the middle of the year. Promotions only seem to happen at the start of the year and terminations only seem to happen at the end of the year. So that's kind of neat, but this method will work anyway. So I'm going to let my months be, it's going to be eDate from the starting point, which I'll lock by a sequence of 12 months starting from 0. And we'll just, for a second, output months. And I'll just temporarily format that. So you can see the 1st of January all the way up to the 1st of December, all of 2025. And if I copy it over here, it's all of 2026 and so on. But now I'm going to undo the format because I don't want to keep that. So those are our months. Then our title is going to be XLOOKUP months in here. So I'm going to look it up in this range, and I'm going to lock the columns and return from this range, and I'm going to lock the columns. And I'm going to say exact match or next smaller item. And what's neat about this is if you look up a date that's before the higher date, you'll get no match, in which case I'm just going to return X. And if you look up a date that's in between hire and promotion, you'll get their higher level, and otherwise you'll get their promotion level. So let's just take a quick look at what that looks like. So here's this person who's like nothing for 5 months and then a director for the next 7 months. And then if I look at them the next year, they're a director all year. And if I look at them the next year, they're a VP all year, and so on across. Happy days. So then the salary is going to be XLOOKUP the title in the salary list, or sorry, in the title list, returning from the salary list. Lock, if not found 0, that'll deal with the X, and divide it by 12 to get a monthly salary. Then I also need to factor in the termination date. So I'm going to say active is going to be if this lock, if that is equal to blank, then 1. Otherwise, what do I want? MNTS less than this. And then my answer should just be sum of salary times active. And we'll format comma, variable decimals, 0 decimals, just a quick formatting robot command. So we can see this person has whatever 7/12 of their $100,000 director salary for the start of the year. Then they have their $100,000 director salary for a full year. Then they're a VP, and they get $150,000 thereafter. This person has again 7/12 of an associate salary, then full year of an associate salary, then they're a director, and so on. And here's a person who gets terminated. So again, 7/12 of an associate salary, full year of associate salary, full year as director, full year as director, and then nothing post termination, which all seems to be working well. Okay, so that is our total salary by year. And then I also want, there were questions also on options vested. And again, we'll do that by, well, actually, I'm going to do that based on the year-end dates. That seems the more natural way to look at it. So options vested at year-end. Cool. So then I guess it's probably going to be helpful just to have, let's just budge this over. So we'll have higher options and promo options. And then just make all the workings a little cleaner. So we'll look up this in this lock, returning from this lock. That's the higher options. Oops, sorry, move that down, move these down. And we'll keep the formatting, because that's good formatting. And then here, same again. Actually, I'll just copy it over and then point it to here. And say if not found 0, because lots of people are not promoted. Happy days. Okay, so then the options vested at the end of the year, we'll just handle the hire and the promo separately. So I'm going to say year frac from the hire date to the end of the year. So in that case, this will be 58% of a year. Here it'll be 1.58, 2.58, 3.58, and so on. So then I want to say that it vests over 3 years. So I just want to divide that by 3. And then I want to, sorry, let's bring this, actually a couple more decimal places would be good. And then I want to take the minimum of that and 1. So in other words, here there's whatever they've had a little bit more than a half a year of the 3-year period. So in other words, a little bit more than 1/6. So that checks out. Here they're a little bit over halfway through. Here they're almost all the way through, and then here they're fully vested. So that is the fraction of their higher shares that have, or their higher options that have vested. So I just lock that to that, and that gives me that. And sorry, this format didn't carry across, so let's move that. And then we want to do the same thing. Oh, sorry, not quite done here, because there's an additional twist that I haven't handled yet, which is year frac helpfully goes backward as well as forward. So if I say it says start date and end date, but if I have these the wrong way around, as in this case where I'm going from June 2027 to December 2025, it'll just flip them around for you and say, oh sure, year frac of that is whatever, 1.4. But this isn't 1.4 years, this is 0 years because you haven't got there yet. So we also have to multiply by higher date has to be less than or equal to the options, the vesting assessment date. So that'll zero out anyone who hasn't actually started yet. And that's altogether more sensible. So that's the higher shares, and then we just need to do the exact same thing for the promo shares. So just copy all of this because it'll be minor adjustments. Okay, so then instead of the higher date, it'll be the promo date. Period end date is the same. Higher date goes to promo date, period end date is the same, and then instead of higher options, it's promo options. So instead of PQ. Okay, and then we can carry over the format, and then we just want to sum, not including the header, that, and the same thing for that. And now I guess we can look at the questions quickly just to make sure we're on the right track. So what is the total salary paid excluding the founders in 2027? That is 871,667. Yes. Total salary paid excluding the founders in 2029. 2050, yes. How many shares will be offered to employees? 3 to 22, either due to hires or promotions. That's just the sum of these, which is 335, which, no, it's supposed to be 300, which does sound more familiar. Uh-oh. What have I stuffed up? Oh, whoops. Yes, I did the promo shares based on the initial hire. Whoops, slap on the wrist for me. So now it's 300,000, which makes more sense. And I guess I should have really put a total at the bottom of those as well. Okay. Oh, and then how many options will have vested on or before 12/31/2027? 69,028. Yes. Okay. So that's the personnel bit up and running. And then we can link this personnel cost. Are we adding or subtracting our expenses? We are subtracting them. Okay, so then this is going to be positive. So personnel cost will just be that and carry over to there. Okay, and then for the rest, we need to go to the financials. So 2025 financials, revenue is $200,000 with COGS at 70% of revenue. Okay, so 200 COGS. Oh, sorry, here we are. Percent of revenue, 70%. Operating expenses were $50,000. It's here. We had 3 hires. Yes, payroll of this, and EBITDA of that. Both founders have forgone their salaries of a total of $500,000 in exchange for extra shares. So where's the adjusted EBITDA? I think that's already done, but yes, adjusted EBITDA. Oh no, it's not actually calculated. Fine. So then I guess we're saying founder salary is 0, but then where's, fine, I guess this should just be this minus, hang on, is there, I'm getting the habit of just typing stuff in, but I guess this is the assumption cell to link to. So let's just add in another line for foregone salary, and that will be 2 times the $250,000. Not in that format, thank you. Format, comma, decimals, minus the salary paid here. And then the adjusted EBITDA will be this minus that. Happy days. Okay, so that's year 1. Oh, and I guess I have to, so revenue multiple times revenue, wherever that is here. And adjusted EBITDA, wherever that is here, times that. And then the negotiated valuation, I think that's in here somewhere. The larger of the two. Yeah, whichever is higher. Okay. All right, no, that one, this one. So max of this and this, but those are still to be updated. And total diluted shares, we'll have to come to the cap table for that, so we'll get that later. Oh, whoops. Look, there it is. The founder salary is right there. I did not need to add that myself. Okay, fine. So foregone salary prior year. Yeah. Foregone salary prior, no, that's foregone salary current year. No. Yeah, that's current year. Okay. Anyway, fine. All right, whatever, it doesn't make a difference. I guess I'll be vaguely proper and link it to that. And get rid of that. Okay. Where was I? Oh, EBITDA margin. What is it missing to? Why is that giving an error? Oh, maybe it's just formatted to not show negatives. Yes, it is. Okay. All right, never mind. Let's carry on. Year 2. Financial highlights. Revenue grew 200% and COGS as a percent of revenue was reduced by 10 percentage points. So revenue grew 200% and this minus 10%. I will say I don't love cases where you have to type things in here because it feels like a source of error, but never mind. We managed and will manage corporate expenses to grow such that 10% of every dollar of revenue growth goes to corporate expenses. Okay, and the founders drew a salary of $50,000 each, so 100. And then operating expenses, sorry, what? 10% of every dollar of revenue growth goes to corporate expenses and will manage. So I think that's the formula forever now. So it's going to be this plus this minus this times 10%. Obviously, don't ever type a hard-coded number into a cell like that. Okay, year 3, 2027. Revenue grew 150%. COGS as a percentage of revenue was reduced by 5 percentage points, so minus 5. Founder salary, 50,000 each. Okay. And then, yeah, the additional cash is going to be a function of the cap table, so we'll come back to that. Okay, revenue grew 75%, 5 percentage point reduction in COGS. And the founders drew 150K each. Okay, and 29. Revenue grew 100%, down 10 percentage points. And they drew their full salaries. Okay, and then 2030. At its 2030. Okay, sorry, here we are. Valuation is based on the, sorry, this is behind my face and my timer. 75% revenue growth forecast and reduced by 20%. Oh my gosh. Okay, so 75% growth and down by 20%. Great. And they draw their full salaries. Okay. So that's that. Let's see what we can answer questions. What is the projected revenue in 2030? 9187, yes. Operating expenses for 2030, 94750, yes. EBITDA in 2030, 3851250, yes. Company value in 2026, 1.2 million, yes. Company value in 2030, 23107500, yes. Okay, now we're on to the cap table, which is a whole other thing. So let's set something up for that cap table. Now, I like to build my cap table as an actual table. So I'm going to do it that way. So investor, round, round and description, I guess. We're going to want shares. I'm in two minds as to whether I even want options as a separate thing or not, but let's do options. Cash. Anything else? I don't know. That's all I can think of right now. So let's just start with founders. Round one, which is founding. They get 200,000 shares. No options, and the cash is 200,000. Okay, so now we'll just make that a table. And I guess just to be cute, I will call my table cap, because now it's a cap table. Haha, get it. Don't worry, that wasn't meant to be funny. All right, so now we can go back to the PowerPoint and look at what happens to the cap table as we go along. So first it's just the founders. Then it's the founders round two. So the first thing that happens is salary replacement 2025. And that is they get 500,000 shares. And I guess I can just, no, I can't paste a link into a table. Fine, whatever. Just gonna link to there. Okay. And also let's, while we're at it, format, comma, 0 decimal places. Happy days. Okay. So first shares were issued for that. We then issued shares to Franny Fink so that she owned 50. So personnel, we hired 3 new people, the most important of which was Franny Fink as our CFO. In order to get Franny to join us, we incented her with shares such that she would have 15% of the company after 2025 founder shares for salary were given, but prior to creation of the option pool and our angel investment. So Franny Fink joins, gets 15% of the company, then employee stock option pool for 300,000 shares. There's a note that FF, the CFO, is still eligible for the 50,000 stock options at higher. That's separate from the 15% actual shares, not options. And then we get an angel investment. So one thing at a time. I guess FF, and this is, I don't know, hire agreement, CFO hire. And at this point, FF needs to have 15% of the company. The thing to watch out for is just, you could look at this and say, well, the company so far is 700,000 shares, and so 15% times that is 105,000. But then when you add that in, the combined company is 805,000, and 105,000 is only 13% of that. So what you actually need to do is you need to have 105 be as a percent of this. So this is going to be whatever x, this is going to be 0.15x, and this is going to be 0.85x. And so your x is going to be this divided by 85%. So that's your actual total that you're aiming for, and then that minus this is going to give you the shares that Franny Fink gets. So that's all a bit of a long way of saying it, but we're going to say sum of this divided by 85% times 15% is 123,529. And again, no cash here because these are just awards. And I guess now is a good time to start showing you. I set this up as a table, but it's also obviously important to keep track of shares so far and ownership percentages. So to row unique of this. The way I like to do that is something like this. So I will say some ifs of the shares where the round is less than or equal to and this round, and the investor is this investor, and we'll format comma 0 decimal again. And then I'll just leave some space because my list of investors is going to grow as we go along. So that's the number of shares, and then down here we can say this divided by sum of this. to get format percent variable decimals. I think we want two decimal places. So this is shareholdings, and you can see now Franny Fink has exactly 15% at the time of the thingy thing. And just for good measure, I will XLOOK up this in the round number returning from the description. So now you can see why I have both a round number and a description. So these guys get their 2025 salary replaced. We hired the CFO. CFO owns 15%, and we're good to keep going. Okay, so next thing, then we create a stock option pool. So the investor is going to be ESOP. That's going to be round 4. ESOP setup. And we do options of 300,000 and no cash again. These are all non-cash transactions. Okay, right. And then let's just carry out the formatting over here. You can do this all as one big thing. So instead of doing that, you could just do J3 hash, and it would calculate them all in one go. And then you could do, this as these values divided by the bicol sum. The reason I'm not doing that is because it's pretty common, and I think it does come up in this case, that you'll want something like, someone invests at a level that will maintain their existing shareholding. And so, a calculation over here is going to depend on a shareholding over here that refers back to an earlier round. But if this is all calculated as one big block, then you create a circular reference. So we want to avoid that. Okay. Yeah, that's fine. Okay, so now, yeah, that part's fine. Finally, Tenchi Angel invested $100,000 and brought on Ventura Charles Capital to invest $500,000 on a pre-money valuation based on the 2026 revenue over EBITDA. Remember, the forecasting is clairvoyant. Okay, so we get Tenchi and what are they called? Ventura Charles Capital. We'll call them VCC. And this is round 5, which is, I guess, the seed investment, I think they called it somewhere. I'm not making it up, right? Yes, first seed capital. Okay. So we'll call that seed. Seed. So Tenchi put in 100,000. These guys put in 500,000. And then total diluted shares at valuation. Now, this I have to pause and think about. I think the answer is that the founder shares get issued at, yes, the founder shares get issued on 12/31. So those are issued. But then I don't know the timing of I guess the hire and the ESOP are both 1st of Jan events. So I think our fully diluted shares, and I guess I should put a total up here somewhere, be a useful thing to have. Total. Let's be some of this. Carry across. I just need to expand this. And do the same thing here. Okay, so then I'm looking for the fully diluted shares outstanding at valuation. I think we're looking at everything up to the prior round. Oh, sorry. Fully diluted, so I have to include the options. I don't love that way of doing it, but it'll do. Okay. Fine. So then that gives us $1.07 valuation, which means that these guys get this divided by this. And the same. Okay. So now we have our numbers of shares. Just got to copy that across. And copy this across. And now we're moving. Okay, good. All right, so then 2027. Cap table. First, shares were issued to founders. Yes. So, so they have $400,000 in foregone salary, which means this many shares issued. So we'll say founders. This is round 6, which is salary replacement 2026. and their additional shares are these many, and no cash. Okay, good. Tenchi Angel gave a convertible loan of 300,000, such that it would accrue 5% interest per year and would also receive a 30% discount in Series A investment. So I think I'm going to record that in the cap table, even though it's not exactly capital. So this is convertible loan, and that's 300. Oh yeah, sorry. I knew there was one other thing I wanted to have in this table, and that's a year. So this is 2025. Don't want that format for this. Then this happens. These are all 2026 events. These are 2027 events. And then I should be able to figure out my additional cash. There we go. So now this should be some ifs. This where this is D6. Cool. So we get $600,000 in additional cash there. Yes, that makes sense. Then we get the convertible loan. Yes. So that's $300,000 in additional cash. Happy days. Okay. So what's next? Okay, so then I think we can go on to 2028. First shares received to the founders, yes, so the usual gig. So this is round 8, replacement for their 2027 salaries. And have we got everything in place to do this now? No, because I haven't put this in total diluted shares. So that's going to be, how did I do this? I did this through the end of 27, right? So N4, yes. There we go. And we'll expand all this as well. Okay. So sorry, I want everything before that. So that is the 1759. Okay. So then now I have this number here, which for some reason I can't paste special link into the table, but never mind, I will link it anyway. That's 0, and that's 2028. Okay, then next event. Then the Series A financing was raised. Okay, so Tenchi. Now, so we're gonna. So it's a little woollier than I would have liked on the timing here, because at some point in 27 we get a loan at 5%, and at some point in 28 we pay the loan back or convert the loan, thereby paying it back. But fine. I feel like I'm doing this wrong, and I probably will have to go check the main thing on this, but for now, 9 Series A. So VCC invests $350,000. We're in 2028 still, yeah. And then Tenchi invests nothing, but gets 315,000, which I think I want to record as minus 15,000 because you got to pay off. Shoot, someone's at the door. I'll be back. Okay, I'm back. Sorry. Oh yeah, I think I just talked myself into putting the negative for the cash here, but no, this is not a cash event. Don't do that. So we keep the $300,000. He'll get more shares because of the interest on it, but he's converting it, so no cash event there. What else? Oh, sorry, we have another investor as well. 2 VC investors added another $500,000. Stock options exercised by the leaving employees will be addressed first in 2029. Okay, fine. So 2VC, also in the Series A, $500,000. Okay, so now, here's our valuation. Am I doing the right year? No, I'm not. Total diluted shares. What am I doing? Cap table Q4. Hold on. Cap table Q4 means I've not included. It's supposed to be fully diluted. So sorry, got to include this as well, which is the ESOP pool. Okay. So now for 2028, it's going to be everything before the Series A, meaning up to round 8, which is to say column R. Okay, so this just becomes R. Okay, so then our valuation is 225. So these two guys get this divided by that number. Now this guy gets, so he gets his 300,000 times 1.0 times 1.05. Again, normally I would expect all these assumptions to be in cells here and I'd be linking to them, but whatever, I'm doing it in the style of a competition case, so that's fine, don't worry about it. So that's the value of the investment. Now I got to divide that by the share price, which is here. But then also keep in mind that this guy got a discount. Is it mentioned here? No, it's not mentioned here, but it is mentioned in 2027. Would also receive a 30% discount on the Series A investment. So we got to divide by this times 70%. So he ends up with more shares as a result. Okay. The odds that I'm getting all of this right in one go feel slim, but I will carry on for now and we'll fix things later if needs be. All right, 2029 cap table. First shares were issued to the founders. 2 employees who left decided to exercise their vested options. Non-vested options of these employees were forfeited. Don't forget to reduce the option pool. After that, the price per share was calculated for the Series B. Okay, so first founder salary replacement, which is this, but now it's round 10 and it's replacement for 28 and it's happening at the start of 2029. And the number of shares is this. Sorry, I can't do it that way. I'll do it this way. Okay. Second, we have employees leaving. So I need to know how much they had vested at the end of. And actually, I guess it would make sense to add. Oh, never mind. That doesn't matter. So this is going to be a little bit shaky. Doesn't matter. So round 11 is the leavers leaving. So their vested shares, where are they? They're row 36 and row 42, which is to say that and that, I think. 13,611 shares. So here we'll say some ifs. This block where this block is whatever greater than 0. That gives me that, good. And then the options is correspondingly reduced by. Oh, I didn't put a total. All right, let's put a total. Total options. So you just hash each of those. I'll do that and then carry that over. So that now I'm looking at R hash. So R 34 hash. Okay, so now there's only 280,000 options. So this is option exercise. Sorry, where did it? Yes, don't forget to reduce the option pool. The non-vested options are forfeited. Yeah, so I think that's right. After that, the price per share was calculated for the Series B. So then, yeah, so we want to go out to round 11. Total shares in round, wait, sorry, we haven't filled out this yet, so let's do that. Out to 11, I guess there'll be a few more rounds after that, but we'll get to those in due course. So the levers have that many shares, yes, that's good. This is a 2029 event also. Oh, and they have to pay for them also. There is going to be cash from this, which I'm just going to do as a very manual calculation. So this person, let's see, they were hired in 25, left in 28, so 5, 6, 7, 8. Yeah, so their higher shares were, this one's higher shares were fully vested, which is not the question, sorry, the valuation. So they, sorry, they have 5,000 shares for which they had to pay the 2025 price. So let's just do it this way. 5,000 times the 2025 share price plus they had another 5,000 promo shares which had vested for 2 years and for which they had to pay the 2027 price, which is this guy. Okay, and then the last person didn't get a promotion, got hired 6/1/27 with 10,000 shares, and actually I can just go straight to the, this is how much was vested. So that many vested shares times the 2027 rate, which is again here. So that's the cash that we get from those. My confidence in that being correct first time, extremely low, extremely low. All right, so what's next? Now we're doing Series B, right? Yes, so after that, price per share for Series B, so have we got, no we haven't, so let's go do that. So up to round 11 is our total shares plus this lock plus this lock. Now, that feels right to me, although I have a funny feeling I remember what the options pool got reduced by being just this 13,611, even though it says the non-vested options are forfeited. I don't know. Well, I'll check against the answers in a minute and we'll see what happens. But for now, let's do the Series B. Series B investment total 500,000. Much of the amount was invested by FMWC. The two VC investors have purchased just enough shares to prevent dilution. That is to keep their... Okay, so this is what I was talking about before, the non-dilution plan. So we got FMWC and we got two VC. This is round 12, which is the Series B. No, not Series A, Series B. Which is again a 29 event. And okay, so here we've got 500,000 times 2 VC's share immediately before, which is their round 11 share, which is this line, which is 8.19%. If I'm right up here, which that doesn't look familiar, so I think I'm not, but never mind. I'll fix whatever's wrong in a minute. So that's FMWC's share, and then the valuation is based on that share price. So it's this divided by this guy, lock, and that. Okay. Good. So then we just carry these out, and we carry this number formatting down and across. Okay. Boom. We're almost there. No foregone salary. No, yeah, that's fine. So then I just need the final fully diluted shares, right, for which I guess I need to read this. Okay. Congratulations, FMWC decided to buy Upstart LLC at its 2030 valuation. With this purchase, all option holders were able to fully vest their shares and can buy them at their strike price. Right, I hadn't thought about strike price, had I? Okay, let's do this. Strike price. So this is going to be this times index. This is the share prices by the year of hire, which is D34 minus 2024. So in other words, 2025 is the first one, and so on across. That is your hire shares plus the same thing for, let's say, if F34 is not equal to blank, then it's going to be Q34 times the same index calculation, but just pointing at a different year, a different date. So that one's going to be off F. Okay. And then we need to do the strike price for everybody who has not been terminated. So I guess I'll just call this ESOP. We'll say minus 280. 280. And then the cash for that is going to be sum ifs strike price, where term date is blank. I think I can do 0. No, I cannot do 0. Can I do that? Yes. Okay, and that is a 2030 event, I think. So then that, yes, our options net out to 0. That's that. That's 13. This is ESOP exercise. Okay. So then we come out here. Yeah, I just called that ESOP. That's fine, I think. Okay. So then the shareholders receive proportionally to their holdings the sales proceeds, equity value less the 7% cost, sales proceeds equal to the enterprise value plus all the available cash that accumulated in the company. The company has no debt. Okay. So I'll just do it here for want of a better place. Exit calcs. So the enterprise value plus, okay, fine. So the EV is going to be this valuation 6 times the thingy thing, 6 times the adjusted EBITDA. Cash is going to be this. So then the equity valuation will be this plus this. These will be minus 7% times that. The proceeds will be this plus this. Oops, nope, I do not accept. Go away. Nope, not that one. This one. Yeah, and then who gets what will be this times this. Okay. I guess I was gonna, yeah, no, I'll just go look at the questions with you. You can see if I got it right. Like I said, I think some of this I have definitely got wrong, but never mind. All right, so cap table. After A and BB receive their shares for how many shares does Frankie Fink get to get 15% of the company? Okay, so that is 123,529. That's good. In the January seed investment, what is the pre-money value? Pre-money value is this guy, negotiated valuation 1.2. Yes, fine. What is the value per share after the investment? Well, that's kind of a trick question because it's the same as the value per share before the investment because nobody got share discounts. So 10681, yes, that's good. What was the ending cash value in 2027? 15,000, yes, good. After the founders get their shares for 27 on 118, what is the pre-money price per share? 2.2489. 2.2489, yay! And that is 20, yes, so that's January 20, yes, fine. Okay, how many shares does Tenchi Angel acquire from the convertible debt instrument in the Series A? Series A, Tenchi, 20,095, yay! What are the total diluted shares after the Series A investment? So diluted means we're going to include include the ESOP. So that's 2912497. Yes. How many options are purchased by the 2 fired employees? 13611. Yes, that's good. What's the cash received? 17,542. Yay! Oh my god, this is going better than I expected. How many shares does 2VC acquire in the Series B round to prevent dilution? 11,679. No. All right, so this is where it goes bad. Was I supposed to be calculating their ownership based on the diluted shares? Possibly. What did it say about that? Just enough to prevent dilution. Let's keep the percentage of shares the same. Yeah, no, so then that should be not the problem. Which U19, I did it based on, yeah, the round immediately before, so that's right. And did it result in, yes, it resulted in their shares staying exactly the same. All right, I don't know, I gotta go look at the solution model to figure out what's going on there. I will report back shortly. All right, so it is what I briefly suspected. It said to keep their share of the shares, but this was meant to be based on fully diluted. Okay, fine. So I'll just make another version of all of this, which is going to be the fully diluted, diluted, thank you. And then this one is just going to be, I guess I can just make it cap options plus this to keep it simple. And then most things will be the same, but that is now 300,000. Why is it not going down? There was a round where this went, yeah. Oh, right, because the levers go minus 20. Oh, that's not good. That's just confusing. Ugh, fine. So then this should be ESOP. 11 option exercise. They get the minus 20,000, not them. Oh, that changed something. No, maybe that's okay. I don't know. Yeah. Okay. So now this is pointing to that, which is good. This is that over that, which is good. So now we should see, yes, their shareholding is changing. So it's this 7.42 pre-B. So that's U40 that I need to target. Okay, that gives 10,658. Is that the answer? No. Oh, God. All right, I gotta go do a little more debugging. Okay, yeah. So many little mistakes here. All right, so first of all, they were looking for this to be minus that, which I had a brief suspicion of. And then we'll just make this minus that, minus that. I have mixed feelings about that. I mean, I assume they've done it the right way, but it doesn't seem obvious to me that if you had 20,000 options either used or expired that it wouldn't come out, but shows you what I know about option pools. Anyway, yeah, okay, so then a couple things. One is just this stupid, hard-coded reference to cell 16. I moved it into cell 17, so that's broken. But then the thing that really tripped me up that I don't think I would have got right is this new money. So we had to add this new money. So this is the pre-money valuation. Then there was an investment event. So we have to add that. So then the Series B valuation. So pre-option exercise, the value was 10.5 million. Option exercise adds that much. Post option exercise, you get to this plus this. Oops, no, go away, you bloody picky thing. And then shares post option exercise is sum of everything down as far as here. So then the price per share should have been that over that, which is, it still doesn't look right. It was meant to be like 350 or something. Oh my god, how could I keep getting this so wrong? What? What now? What do you bloody want? Divided by AL. Oh, the 2912. What? What? 3,001,429. Oh, right. Sorry, yeah, because it's got to be the fully diluted. Ugh. There we go. My God, you can see that when it starts to get technical, I really do not know this stuff. Okay, so now, finally, that's our price per share that we're going to use. So then we're going to divide this by this block, and that gets 569. Is that? It better be. Yes, that's it. Okay, fine. Total diluted shares after the Series B investment. So that should just be the sum of everything down as far as here. And that is 3144115. Yes, good. Company is sold and all options outstanding are fully vested. What is the total number of shares during the sales transaction? Right, which is this 3137726. 313, yes. And the difference between those is, hold on, what? Oh yeah, after the Series B. So in other words, the difference between going down to here and going down to there is that these the difference between the 20,000 options that these guys had and the 13,611 that were vested and that they could exercise is this 6,389 that just gets lost. So that is the number of shares, 3137726. Total amount to be distributed, 26254. Yes, 168. Happy days. After all distributions, how much money did Tenchi Angel receive? Hopefully 2457654. Yes. And how much did the two founders receive? 12,032,800. Yes. And what was the net gain on all of the options exercised? The value of the options less the strike price. So that, I think that was the only ESOP investment. So it should be, am I just looking for absolute? Yes. So it should be that minus that, which is 1730502. All right. So I got to be honest, I thought when I was doing this on the day that I was very close to it, but actually some of these technical details, like I was using the 3.5 valuation from here, but not adding in the extra 17,000, which makes a difference. So I would have had a bunch of things wrong, even if I hadn't made other silly mistakes, which I did. So yeah, I thought this was going to be super breezy to go through on a second time round, but actually there's a lot of devil in the details here. Which is good. This is me learning a little bit about share options and venture capital and stuff that I don't know much about, don't model much in the real world. So it's fun. All right, that's all I got for today. Thanks for watching. See you next time.